We hear about capital gains all the time on the news. Certain lawmakers want to increase the capital gains tax, decrease the capital gains tax, or sometimes they want to eliminate it altogether. So I wanted to make this video and define what capital gains are. So there's two types of capital gains. Capital gains are basically when you sell an asset, you're either going to have a gain or you're going to have a loss based on what you paid for it, based on what your basis was in that capital asset. So I'm going to give you an example. Let's say you bought a piece of real estate for $200,000 and you held it for a year and a half, and then you sold it for $400,000. You're going to have a basis of $200,000, and you're going to have a long-term capital gain of $200,000. So in this particular example, the $200,000 of profit is your long-term capital gain. Why is it a long-term capital gain instead of a short-term capital gain? Well, it's a long-term capital gain because you held this asset for longer than 1 year and 1 day. If you'd held it for a year or less, then it's characterized as a short-term capital gain. Well, what's the difference? What's the real difference between the two? Why do you care? Well, short-term capital gains are taxed at ordinary income tax rates, which are usually less advantageous. Long-term capital gains are taxed according to one of three brackets: 0%, 15%, or 20%. So a lot of people will hold stocks and they'll sell, at 11 months and 17 days. That's just how they just decided they had a feeling that they were going to sell and that would be a good thing to do. And that's not necessarily good because you're going to pay short-term capital gains rates on that. Why? Because you didn't hold it for longer than a year and 1 day. So in that example, if the person had held it just, 16 more days or something like that, then they would have actually been able to sell and only claim the long-term capital gains as opposed to the short-term capital gains. So it's important for you to know the difference between long-term capital gains and short-term capital gains, and it's important for you to also keep track of your basis. How much did that capital asset cost you? How much did you invest in order to acquire it? Because the basis is going to offset the sale price, and you're only going to pay taxes on the gain. Now, you could have a capital loss. You can have short-term capital losses or short-term capital gains, and those will be the subject of a different video. If you have questions about this or really anything else that has to do with taxes or tax planning, I invite you to visit our website at tax.co.